Welcome, ladies and gentlemen. Today is the 16th of Feb 2021. It's 32 minutes past 2 local time. This is Euro-Dollar an hour chart trading at 1.21303. And boom, here we go. Look at that. Stop run down, taking out this empty, those short-term stops. And guess what we have here right now again? We have again the lasso principle. You see? So those long positions of the dumb money have to be priced in with this down move. And when they did the stop run earlier above the high to take out all the stop accumulations here, those were in the tolerance, so they quickly had to snap back down. You can see by the dumb money switch indicator, the tolerance, both longies and shorties, were similar and overall at the medium level. So that indicates some dumb money tolerance ever shown before. Watch the dumb money switch video if you haven't seen it. And alright, why not capture some of this stop run here? It's all about stops and positions, obviously different types of stops, and the dumb money positions have to be considered in the context of dumb money tolerance, as I've shown before. But the nice aspects of this game is that the price chart itself is a two-dimensional expression. Now obviously the price moving mechanisms behind the curtain, they are multi-dimensional, but the output is two-dimensional. It's the exchange rate over time. And yeah, I said I switched on the video just in time. So stop run to the upside. This level here is cleaned. Then quickly down move, lasso principle, taking those longies back into loss before too many can close. In the process, of course, taking the big medium-term stop and short-term stops here, which is happening in front of our eyes once more. Nothing is random in this game. I hope this is clear by now. I always say the market causality is a bit like a window. When it's clean and you can see through it, then you can trade. If it's not clean and the bias is not high, just stay on the sidelines and wait until there is a bias and you can place a trade. Okay, this is an essential rule of trading. Not having a position is a position as well. And eventually, after some time, trade setups occur and moves become predictable. Okay, so that's not random, that's deterministic. Yet, the whole academic world still writes papers on the randomness of markets, not knowing what's going on behind the doors. Okay, so smart money bars down, as I call them. Taking the target, pull back here at the little shorties after this MT has been kissed. And of course with this move here, this low has been cleaned. As we can see, the short-term subs disappeared now, they turned yellow and disappeared. As I should. Now the price is exactly between the longies and shorties. Again, several nice concepts all here in front of your eyes. Yeah. Fake resistance drawn into the chart. Novice traders think they can short it and place a stop above the high, which is exactly the wrong thing to do. So fake resistance painted in the chart, boom, stop hunt up, taking out all the stops of dumb money shorties which came in the market into the market over the last 20 hours or so. Right, target has been reached. So Lasser principle, boom, down to quickly catch in those dumb money longies who are breakout traders who entered expensively in the market trying to trade a breakout towards a high, who were a bit into profit as you can see, but only the minority manages to close. Once the mission has been completed on the upside, boom, quickly going down, catching in the longies, going for the stops of the longies. Yeah, we've seen live here like a stop hunt of the dumb money longy stops. So guess what? Short is taken out, long is taken out. Okay, whipsaw. That's what this game is about. All right, lured traders on the wrong side into the market, taking them out on both sides, and following the principles explained of the market causality, so that by doing this over and over and over again, overall the dumb money will lose. Sure, those longies have been temporarily into profit, but that was quickly over. Otherwise, you know, if there wouldn't be any dumb money tolerance, they couldn't move the price as much as they do. So that all makes complete sense, yeah, once you have understood the market. If you really understood the market structure, it all makes complete sense. Because the smart money has full price control. It's a cartel. It's, you know, a low number of players colluding and exploiting their informational advantage. Simple as that. So this is our response to it, you know, trying to reverse engineer that and to make sure we don't end up on the dumb money side. Protect ourselves. And this has enormous value. And most likely, most people have not really discovered the implications of this content because, you know, we're talking this in front of your eyes, the real dollars, the world's biggest financial market by far. You know, with trillions in volume, much bigger than any stock markets or crypto markets or whatever. It's like, this is the world's biggest market. And Forex altogether is by far, in terms of volume, the world's biggest market. And look what happens next. Look, short-term stops of dumb money longies, they're just eaten now. In front of our eyes, the blue lines here. So let's capture more of this nice move, because it enables you to understand these things better and better and better with every video. Of course, I really recommend you to watch the educational videos, because they show you the concepts, and you know, then after you have watched those playlists, you come here and you see the thing live in front of your eyes. It's powerful to have some nice high-level free education for you here on YouTube. How cool is that? And you can see where the edge is in this game. You know, this information here is leading. It's leading. You can see before what the price will do, just by understanding the complete content. It's not rocket science. It's not, you know, some people feel overwhelmed at the beginning, but they shouldn't, because it is not really rocket science. Those concepts, you have to study them a bit, but once you understood them, they get into your blood. And come on, I mean, you know, there's much more complex content out there when it comes to science and so on. So at the end of the day, once you understood the big picture, it's not that hard to, with that framework in mind, to look at the market and see the structure and understand how this game is played. Okay. Now, not many people have any knowledge of all that. Even people, you know, working in banks and so on, they don't understand that, which is really ironic. But, you know, I was able to expose all this. So, not since yesterday, since half a decade now, believe it or not. My first video was 2016. So, it's, you know, almost 5 years. That's crazy. So it's a market structure driving the price. It's not You know, that's not that the price is random or anything. That's the first. The second is, it's not that supply and demand is there, and if there are more buyers, the price goes up. That's definitely not the case. Look at that. Shorty sellers come into the market, but they're on the down money side, so the smart money pushes the price up against them. It's pretty much the opposite. And they'll have to whipsaw. They need to take stops on all sides. They also need to fill limits. They need to also lure traders in the market. They do all these things simultaneously, and at the beginning, when you don't understand the game, you think, oh, how can this be? That's a contradiction. But as you can see here, it's not a contradiction. Because guess what? By doing this, by drawing this fake resistance into the chart, at the same time, each time they do these little moves, they get down money longies to buy the dips, as they say, in towards a high, which happened, you see? So they not only lure down money traders on the wrong side, but by doing that they prepare the big stop run, and of course the whipsaw move back down based on who gets loaded into the market. Now all they need to do, they just need to react to how the dumb money trades. That's it. If there would have been more longies, they may not have conducted the stop run up, because then the longies would have gotten to profit. You understand? Those longies were within the tolerance, as you can see. So they prioritized the upper stop hunt to the anti-position move they can do now, right now in front of our eyes. So one doesn't exclude the other. As long as they are quick and they move the price in a deceiving manner, they always achieve it. Now, obviously, sometimes some of the longies get lucky or quickly close their profits. It happens. You know, it's not that every one of them gets caught. But it's always a minority who closes in a few pips. And obviously by holding over those positions and then just collecting a few pips overall, that's not a profitable strategy. You understand? So from the perspective of the buy-side traders, if they hold over large counter moves and only collect a few profits, that's a bad risk-reward ratio. And if your win-loss ratio is not very high, this overall will be a losing strategy. So within the downward tolerance, a few longer positions in profit are acceptable for the smart money. Okay, I've called this down money tolerance. So the price has room to move. But there's no rush. Remember, they can always consolidate. But here we see some beautiful. We see the main run, post main run move. Now the counter stop run. Look at that. As boom, turning yellow. This look, short term stop taken. Now look, boom. They go for the empty, straight to the empty. Look at that. Add a spread to this, so they will take out this medium term stop accumulation of the dumb money longies. That's the reason why they moved down. Nothing else. Okay. People don't get it. Beautiful. So that is evidence, okay? That's hardcore evidence. You can't ignore this, all right? You can't ignore all this evidence I've publicly collected here. You know what I mean? I've done everything. I've predicted moves. I've done live analysis. I've done live trades. I've done videos, okay, with timestamps and everything. And now, look here, you see it again. You can't ignore that evidence. I'm sorry. It's a reality. That's why I called the first channel Fox Reality, right? Where I was exclusively live trading. So there you go. Short-term stop run. Now the inner range medium-term stop run in front of our eyes. Boom. There we go. 1.2112. Smart money is hungry today, has appetite. So it's taking out traders around the world. And again, understand, these are not, you know, like little traders. These are also corporates, I've explained many times, all right? And also understand that some of those corporates, they are in the market not for profit, all right? Some of them, they just want to hedge. Understand that as well. Okay, so it's not that it's only, let's say, evil market manipulation. This is also, to a smaller fraction, kind of the natural nature of the beast, let's say, the how the markets works So speculators, of course, are targeted, but also big corporates placing orders in the market. Yes, also there are limits getting filled. Yes, okay, I've explained that also before. And the market deviates towards those limits as well, for sure. Plays a role. There are other things as well, okay, which play a role. For example, option strikes play a role in the market as well, in forex options. But still, excuse me, on the big, from a big picture perspective, I mean, this is the game. And it's no coincidence that it does the pullback exactly here. Look, we saw it before. In terms of tradability, well, experienced traders that like to trade post-stop run scenarios, for example, the exhaustion back into the range. It's always a little bit more difficult to trade the target move itself, because you may be too early. Yeah? Let's say you see a stop accumulation and you want to trade towards it. If you see a stop and you know the price will eventually go there, that doesn't mean that you just place a trade towards the stop. That's something I should emphasize. Because look, you may be too early. They will still want to draw in. They want to use the time range principle, and then eventually they do the move. Okay? So it's always a bit more difficult to trade the actual target move, the move towards the target. But I do that also a lot. And but looking at different setups, that's always a little bit more tricky than trading, for example, a post-stop hunt exhaustion move where the target clearly has been taken and the high, for example, has been cleaned once more, and then, you know, there's an exhaustion move and the dumb money switches on the other side. That is easier to trade, generally speaking, because it allows you also to enter at better prices into the market. Whereas when you try to trade towards a target level, you need to make sure that you get your timing right. In particular, if there's no rush for the smart money. Remember, there's no rush. There's a stop accumulation. They don't need to quickly take it out. Nobody really knows. So they rather, you know, go flat and everything, and often you get better prices. You can place a limit, and then if you get a good or a better price for your entries, you can enter several times as well. Then, you know, that's most of the time the better choice, more optimal, rather than analyzing, okay, where does the market want to go, and I just trade towards there. Okay, you need to incorporate obviously other factors such as news announcements, higher time frames and levels there, the money flow, okay, economic plausibility, correlations, etc., all right? So that's a thing I should emphasize. So for example, if the price came down here, right, with the dumb money switch, look, the main targets have been cleaned, the low has been cleaned, switch from longies to shorties, an up move here with a better price entry. Even if you don't get the perfect entry several times, that these post-stop hunts are easier to trade. Here, fake support, fake resistance, ranging, target up here, shorties come in, you want to buy around here, for example, you may be too early. And you can't use a tight stop or something because you may be placed correctly and get stopped out. Obviously, that's not what you want. Very important point, this one. Okay, understand what you're doing in the market. I mean, what are you trading? You know, even if you're blind, even if you only see the price, and of course that will confuse the ones who have understood that most of the time the dumb money tries to trade a reversal, leading to a fake reversal in the price chart. Like here, you see? So look, the price goes up. The dumb money thinks, well, I want to short this down. This is too high. And by shorting, 1, 2, 3, 4, what happens? Boom. Failed reversal, the price goes up. You see? So the failed reversal is a very common setup, and it's tradable. So here, price goes up, gray pattern filled, this target has been cleaned, price exhausts, and here look, shorties say, you know what, let's short back to the low. So what happens? You can buy against the shorties up and make this a more complete gray pattern on a longer time frame. You understand? So here you're trading a failed reversal setup, and you're not necessarily entering cheap into the market yourself, but you're trading against the psychology of dumb money shorties thinking, oh, I shorted back down, right? So distinguish those three setups, okay? So post stop hunt scenario, dumb money switch, normalization move into the range, okay? Failed reversal setup, price comes but will continue and do some kind of squeeze, also very common. And then thirdly, the trades towards targets, which is more tricky, as I've said before. Look, we have all three nicely on this euro-dollar chart from today. How cool is that? All three of those different scenarios. Yes, there are others as well, but to keep things simple and also for new people watching this, that's a very good way of understanding three tradable concepts on one single chart. Post stop hunt, dumb money switch, failed reversal against dumb money accumulation, target hunt towards main target. And this back down, of course, would be, again, a post-stop hunt exhaustion move with a Lasso principle. So a bit more complicated, okay? This is not really a dumb money switch trade, understand? So this would be a fourth setup, which is advanced. I've shown in the video before, because you need to understand the dumb money tolerance principle. So that's advanced stuff. Target has been taken. Remember, also George has shown that many times. He likes to trade back into the range. And then, you know, of course, if up here we would have had massive short traders like here, guess what? It would have turned into a failed reversal and take the next target for sure. But look, those little shorties were within the tolerance. The Lasso principle was still ongoing with longies in profit. And even some little longies came into the market. That's enough for them to do a normal exhaustion move. Plus, of course, taking the stops on the other side. In just 2 bars. Look at that. Quickly, boom, boom. Killing everyone on all sides. That's the nature of the beast. That's why Forex makes everyone lose, okay? Because from your side, you don't have a clue what's going on. You think, oh, yeah, this price has strong down momentum, I want to sell. Wrong. Then you say, oh, I'm going to sell the reversal and get nicely into the market. Wrong. Then you say, oh, look, this high has been cleaned, so I'm going to sell nicely into the market. Wrong. Right? Now you will say, well, why don't I just do the opposite of what I think? In a way, yes, but of course it's not sufficient to trade profitably, right? I mean, funny enough, if you would do the opposite of what you think you should do, your entries will be better, but overall will still be losing, because firstly, overall you will end up on the dumb money side eventually, and secondly, you know, you will by trying to do that, you will get into a really, really dark place in terms of your psychology, because you're trying to second guess yourself, and over a sample of trades that doesn't work well, so you will lose as well. Understand, trades are not binary outcomes. People think, well, either the price goes up or down or flat. Yes, but a trade is more than that. It's an analysis. It's you have several entries, several exits. You can manage the positions. You know, it's like, it's not just a coin flip. Understand that, okay? Novice traders don't get it. They don't understand that even though it's a two-dimensional space here, it's not about just up and down. Look at this. It whips out completely, right? Took out short-term subs, drew in fake support, fake resistance on both sides. Consolidated in an irregular fashion, right? And killed stops on both sides. It's beautiful to add this to the evidence collection, kind of. Because you can't. Who can deny this truth? So for you as a trader, okay, I should one day do a nice video on risk management, how you can split up positions, how you can manage exposure and drawdowns and all that stuff. I should one day do that because that's very important. But you have to understand, what your strategy is based on. What are you actually trying to trade? Are you trading fade reversal? Because guess what? Each of those setup and scenarios comes with its own kind of rules and problems. In particular, if you don't see anything, you're blind. Okay, you're a blind player in this. Then your statistical edge quickly disappears. That's a problem. You understand? While this will always happen here, day in, day out, in the future, like the statistics are changed by the algos, and of course, based on the dumb money changing its flow and responses. Look at that short-term stop run is going on. The pip values change, the range changes, the amount of whipsawing changes, the amount of pullbacks changes, the occurrence of clean trends without pullback changes. We have seen that in particular in the last 1 or 2 years. Those squeeze moves, with only little pullbacks where they're just going for targets. Guess why that happens? Because the dumb money accesses the market and tries to trade mean reversion strategies. The reason why we have seen these squeeze moves so much, where you think, come on, how exaggerated is that? Again going up, not even doing a proper pullback, is because, guess what? Everybody makes analysis, everybody comes up with systems, approaches, EAs, and so on, which tell them, well, we're going to exploit the mean reversion property of the market. So what? Guess what? All of them end up on the wrong side together, creating those squeezes. So the squeezes in the markets, those aggressive moves in one direction without proper pullbacks, they are created by the dumb money trying to implement mean reversion strategies. As simple as that. Why do they do that? Well, because statistically it seems a bit easier to identify mean reversion, which firstly is not really true, and secondly it gives people a better feeling because they think they get better prices, better entry prices. And then guess what? The next thing they do is, like, when the price goes against them, they just buy again, which then gets them into some kind of martingale approach, which will just lead to blow up eventually. You understand? That's the problem. By averaging down, they will have, like, some little winners, but then huge drawdowns. Now, trying to trade those kind of squeeze moves, which are trend moves really, comes with its own kind of issues, because then you need to manage those whipsawing moves. So if you get signals in those areas, if you don't take the signals, you're not in the move when it comes. But if you take the signals, you have a few false signals, you get whipsawed on both sides several times, and you lose money, you accumulate losses before eventually you catch something which gives you a bit of profit, which often does not balance the losses you suffered from the whipsawing. You understand? Now, this is all on purpose. This is not coincidence. So that's what the smart money is aware of. Look at that. Look here. Short-term stop, telling yellow going. Look, they're going for this one too. They're just, doing a stop hunt going all the way while we talk. So, of course, statistically, if you're blind and you have your price-based indicators, you may try to create a system. So you will find some signals that give you reversal signals. Sometimes they're right, and then sometimes, of course, they're wrong. That's not enough to make money in the market, obviously. Otherwise, that would be really easy. So people try to optimize by splitting their entries, which may improve it a bit, but the risk still remains that if there's a fade reversal, it just never comes back, they get a huge loss. Then if they try to trade the squeeze moves, trends, they get whipsawed. Yeah, like here, look, a long move and then boom, 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 bam, 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 before the next uptrend. This will destroy them, you understand? Now, if you are one of those breakout traders, So not reversal or trend, but then breakout. Look, the price breaks out, they buy, boom, they get all into loss, right? The statistical system tells them, or price reading, oh, look, the high is broken, I buy, boom, they get killed immediately. If you are a pullback trader, it looks a bit better at first sight, but you have the same issues. You may say, look, okay, move, pullback, I buy into the pullback. But what about this here, you see? Excuse me. So, in a down move, you know, pullback here, so I short, boom. So the pullbacks, while they look a bit better on the naked price chart, live you have the same problem with the fade reversals. You see one pullbacks, two pullback trades that would have worked. You see down move is a down move and the price goes up, trend resumption. So that's one pullback. It gets stuck, pullback, trend resumption. 1, 2. But what about this? Stuck, pullback, boom. Yeah, this reversal move makes it difficult to make this such a strategy profitable overall. You see? Yeah, the smart money is prepared. They have accounted for all of this. Guess what? You know. You understand? So each of those setups comes with this particular set of challenges and problems, which all is in complete harmony with the money, with the smart money manipulation principles. That's fascinating, isn't it? I find that rather fascinating, even though one lives based on the other, of course. They are mutually correlated. So, because, look, if the dumb money accumulates on one side or accumulates stops and so on, like here, you know, it's obvious that the priority is to take out those massive shorties and the stops. So in such a scenario, look, this pullback entry long would have been okay. But if these would have been longies, the pullback entry would have not been okay because, you know, it would have conducted a trend resumption down. So if there would be green bars instead of red ones, then boom, that pullback would have failed. You understand? If those would have been longies instead of shorties, the trend would have continued out of the range and do a squeeze move to the downside. You understand? No matter what the dumb money does, accumulated dumb money will be killed. So it all comes down to that in a way, you see? Subject to the dumb money tolerance. But that in itself is rather fascinating that, so despite this is a two-dimensional game, they are able to play those multi-dimensional aspects plus the meter levels, which are in the video course. Okay, the meter levels come on top. And here, actually, I just realized, you know, on this one single chart, you can see a lot. You can see those different type of traders and why their strategies fail. This is why the game is so complex. This is why everybody loses over 90%, you know. Because it's not that people are unprepared or stupid. They just suffer from a disadvantage and they're on the buy side. They're price takers and the smart money is on the other side and influences the price and takes them all out. That is the very nature of the beast. It's not a byproduct. That is the actual mechanism behind this price finding process, as I call it. You understand? This is the actual game. That's what people don't get. Look at that. No coincidence that it does exactly a pullback here. With this pin and the spread, you know, they kiss this level. Pullback. You can see this is all not random. Do you get it or not? And of course, you know, shorty nest here. So that they don't want to just, you know, let them close and profit. At least it'll pull back against those shorties. Yeah. Pricing in the counter accumulations on the position side. And then, you know, once this is over, you just see a naked chart. You have no clue what happened. They knew exactly what they were doing all the way. And scalping, you know, people think, well, so let me just go on a short time frame and just scalp little moves. that is the most difficult of all because what happens is because I just change the range all the time and the pip values, you just get completely whipsawed. You may take a few pips here and there, but then the price doesn't go against you. And even if you use let's say a stop which is kind of balanced or not too far away from the target, or let's say twice as high as the target, still they get you a few times more, but just by changing the nature of the price movement, and your strategy is destroyed because the strategy is completely sensitive towards those kind of pip values. You get it? And if you don't believe me, then start EA testing and you will get the answer. Yeah, if you create EAs, you can create most complex EAs. You can try to make them smart, use dynamic stops, use all kinds of filters, okay? Use smart entries and exits and break-even rules and trailing rules and additional filters and conditions and whatnot. But in the end, the approach just will fall victim to that fact that they have complete price control. The cartel, the smart money. So all they need to do to make your smart approach fail is to kind of change a bit the nature of the price movement, which happens naturally anyways, because guess what? The dumb money is also dynamic, yeah? Sometimes they're more active, sometimes they're less active, okay? We are the first ones to see. Now, sometimes the dumb money is aggressive, sometimes the dumb money insists on one direction, like here, which you look over several sessions, they keep on selling, believing it has to go down, and that creates this up move. And of course, look at here, that's another thing. Right here, those shorties are all a loss. Look, those shorties entered here. These are the shorties, you see? On the y-axis, x-axis, y-axis. These ones here shorted here, around 1.2. Here. So when the price is up here, these guys are already in loss. This is their drawdown. Here's the entry price of the shorties. This is a loss. You understand? So by going up, they just give many of them a margin call who are over leveraged. That's maybe one thing I should really explain as well, once and for all. The ones who don't practice proper risk management, they're the first ones who are brought to the slaughterhouse. Why? Because if they are over leveraged, have a small account in a big short position, they can't survive a counter move like this. The smart money knows this, especially novice rookies, who are just over leveraging, taking too much risk. By moving those prices, they just take out they give them a margin call. They take all the money on the account. Boom. And this is more than you think. Beginning traders, they don't have adequate risk management, and they think they can get rich by trading a small account or whatnot, and they over leverage completely, and many do that around the world, and they accumulate those cowboy traders, and they get taken out rather sooner than later. They don't have the deep pockets to survive such a counter move. So this move up here gave many margin calls around the world, just taking their money, cleaning it out. And guess what? Why are brokers offering then these high leverages? Well, most people should not, be able to trade with so much leverage, because it will make them lose quicker. That's all. So what happens is those novice traders get offered high degree of leverage. They put directional positions. They're not prepared anyways. They have not done their homework anyway, so they just get killed. Okay, so the smart money just collects their money. As simple as that. Think about that. Right? The rich getting richer, the poor getting poorer. Really. I didn't make this up. You know what I mean? Like, it's unfair, but you have to understand that's the nature of the game. Now, some people would say, well, you could say the same about our general capitalist system, right? In a way, it results in the rich getting richer and the poor getting poorer. Because, okay, let me do a little interlude here. The smart money, look, the smart money has deep pockets. The dumb money does not have deep pockets. Now, in general, people who save money, they will hit by inflation. The real purchasing power of their monetary savings will decrease over time. And if the real inflation is around 5% a year, over 2 years they have basically lost 10% of their money. You understand? So just having the money cash means that inflation over time will decrease it. Now, don't get me wrong, that doesn't mean that you should just quickly invest it, because that will lead to quicker losses for the vast majority of dumb money players, let's say. Okay, they will get on the wrong side of markets and other markets, stocks and so on. I will do a separate video about that as well. But if they try to speculate and try to compete with the smart money, they will just be taken out here. Unless people study the game and become good traders, which is my objective, really. I want to give people the opportunity to understand this unfair game, to study it and to become better and to outsmart it. That's really what this is all about. Because it is an unfair game. Now, I hereby was able to give you a better edge to make it less unfair. That's all. Okay, so let's get back to the big picture discussion. So, of course, the other markets are completely controlled as well. Yeah. Stock markets are manipulated in a different way, though. I'll explain it also in a different video. It's not the same manner like here, because it's actually easier to manipulate smaller stocks. Smaller hedge funds can even do that. So remember the Kramer video. That's a topic on its own. And of course, gold markets and so on, they're completely manipulated. I mean, what do you think? Silver, oil. And again, the nature of the manipulation differs. It's not the same like here. It's a bit different. But what happens is, because overall we have so many algos taking over market volume, we have, first of all, correlations among markets, across markets, and secondly, similar concepts being introduced and implemented. Crypto market so far is different, but of course this can change in the future, no question. This remains to be seen. So coming back to the on the more society level, well, if people take on debt, they may have some liquidity and can invest and whatnot, but obviously they lose on the interest. If people try to invest, they have to take the investment risk, which is very high in these days, okay? No matter what they invest in, really, whether it's real estate, stocks, ETFs, and so on and so on. Anyway, so look, here we go. They're going for the next stop. And for your mindset, somebody once said, well, it's not good for your mindset to think about the manipulation. Look, don't be emotional about it. I'm not saying you should be bitter and saying, oh, it's all unfair. No. Take this as a given. Take this as reality. Just accept it, Accept reality as it is. Be very consequent with that. And then once you accept reality as it is, design an approach which can give you some kind of edge. That's the best thing you can do. But don't try to deny what reality is, or even try to force own ideas and concepts which have no basis on the reality out there and risk your capital based on that. That won't work. Okay? Don't believe the supply and demand lie. Don't believe the nobody can influence the price lie. Okay, I've shown you also evidence. I've shown you the Department of Justice statements regarding the big fines that were put on very smart money players over the years. I've shown that in a presentation. The evidence out there. But again, if they wouldn't do it, this market would be different. If they wouldn't do this hardcore manipulation, then look, the market wouldn't be as cheap. You couldn't trade so cheaply. It wouldn't be so liquid. It wouldn't be so accessible. It wouldn't move the same way. So that means the nature of the game creates opportunities for the ones who have the stamina to do their homework. For a minority, it will always be a minority. So the majority not really doing their homework and believing wrong assumptions they get slaughtered, and a little minority which understands all this and creates counter mechanisms as a chance to make some money. But of course, since the minority is also on the dumb money side and can't influence the prices, they also always take a risk, and often also the black swan risk. Okay, they are the price takers. Remember the EURUSD case. Okay, even if we did a 4,000 pip move against the dumb money longies. Okay, many stops there didn't get filled. People got margin calls, even though they thought they are protected, and effectively they did not get protected. But then again, there's always a residual risk. If you cross the street, you may get hit by a car. So risk is a topic on its own, but you have to be aware of the risks you're taking. When it comes to risk management, and that's a big part of trading, you're taking risks, but you have to take smart risks, selected risks, and reasonable risks, and you have to have awareness what kind of risk you are taking. It's not that simple that if you increase the risk, you increase the reward. That's BS. There are many inefficiencies in that, okay? It's not linear process. And at the end of the day, it's all about risk, What happens if the market moves higher than you thought? Okay, at which point can you close several trades together? Do you have some kind of diversification across single pairs? How can you increase? How can you decrease? What happens if there's a black swan event? Can you use hedges and so on? Can you draw down control? Can you reduce positions? Okay, it's like this part of the game comes down to a very distinct set of rules, which is necessary to learn. Every trader, even market causality traders, need to have proper risk management. It's not about gambling here. And even if you see high confidence trades, like, you shouldn't go crazy. Maybe, some of that money was in the tolerance, and you had a bad entry and so on. You need to be ice cold when it comes to risk management. When you're on the wrong side, because you made a mistake or whatever, act. Don't wait and let it just run. Okay, that doesn't make it better. So there can be situations where you need to make a move. And that's where many people fail, because it goes against our intuition, against our instinct. At the end of the day, people hate to take losses. That's the truth. But that's another topic, and I will treat that in a separate video. I want to go for completeness. In the future, I will do different videos, also big picture videos. I will talk about other markets as well. Prepared a PowerPoint presentation there, which I will finish at some point, and I will explain a lot of other things, because I realized that many people don't understand basic things. I assumed that this is common knowledge, and it doesn't seem to be common knowledge. So I will do some work there. And my God, this video got long in the end. That was my intention. Anyways, so we see the stops getting taken out, and this is a beautiful example. Please watch this video several times if you don't get it, because you see all three scenarios in one go. Yeah, and you see several tricks in one nice chart. That's enough. Take care. Goodbye.